twice this century, the market handed everyone the same warning, printed in plain sight. Almost nobody read it. In 2000, it wiped out around $5 trillion in paper wealth. In 2008, it took the house, literally, and nearly pulled the whole banking system down with it. Both times, the warning signs were sitting right there in the numbers. Both times, the crowd looked the other way. Here's the part that should keep you up tonight. The exact same warning is flashing again right now, in 2026, and it is burning brighter than it ever has. One man saw both crashes coming and stepped aside. Today, he sits on the largest pile of cash in the history of American business, and he refuses to spend a single dollar of it. So ask yourself one question. What does he see that you don't? Stay with me, because by the end of this video, you'll see it too. If we haven't met, I'm Sargon, and this is Strategy State, the channel where we put the machinery of money on the table, take it apart piece by piece, and show you how it actually works underneath the headlines. No hype, no horoscopes, just the pattern. And today's pattern is a big one, so let's take it apart. Start with the two dates, 2000, 2008. On the surface, they look like completely different disasters. One was the dot-com bust, websites with no profits, no customers, and no plan, priced like they'd already conquered the world. The other was the housing crash, mortgages handed to people who could never repay them, bundled up and sold as if they were gold. Different decade, different villains, different headlines. But peel off the story on top, and underneath, both crashes ran on the exact same machine. 3 moving parts, every single time. And once you can see the 3 parts, I promise you will never be able to unsee them. Part 1. The price of everything gets insane. There's a number Warren Buffett once called the best single measure of where the market stands. It's simple. It compares the value of every U.S. stock to the size of the entire U.S. economy. When stocks are worth more than the whole country produces in a year, you are, in his own words, playing with fire. So watch that number across history. Before the crash of 2000, it hit roughly 140%, a record at the time, and people were rightly nervous. Before 2008, it climbed to around 110. Both readings screamed that the market was stretched. Now, take a breath, because here is where that same number sits in 2026. Around 230%, an all-time high. The U.S. market is now worth more than twice everything the country makes in a year. And it isn't alone. A second long-range gauge, the Shiller ratio, just pushed above 40, something that has happened only twice since 1929. The first time was the very peak of the dot-com bubble, weeks before it detonated. 2 extreme gauges, flashing red at once. That combination is almost unheard of. That's part 1. Everything is priced the way it's only ever priced at the top. Now, part 2. And this one is quieter, and in some ways, more dangerous. Part 2. The entire market starts leaning on a tiny handful of names. In 2000, it was the tech darlings. The top 10 companies made up about 23% of the whole index. In 2008, it was the banks, a mountain of housing debt stacked behind a few institutions everyone swore were too big to fail. In both cases, the market's fate was quietly tied to a small, crowded corner. So how concentrated are we today? This is the number that stopped me cold when I lined it up. The top 10 stocks are now more than 40% of the entire S&P 500, nearly double the dot-com peak. The so-called Magnificent Seven, the AI giants, are worth somewhere around $22 trillion between them. In 2025, AI-linked companies drove roughly 80% of the market's entire gain. And in 2026, one company, Nvidia, accounted for about a fifth of the market's rise all by itself. Nvidia became the first company in history to be worth $4 trillion, then 5, larger than the entire economy of every nation on Earth except the United States and China. When the whole market is balanced on that few names, you don't need all of them to fall. You need one to wobble. That's part 2. And part 3 is the one that made the hair on my neck stand up because it is a photocopy of the year 2000. Part 3. The money starts moving in a circle. Back in the late 90s, telecom companies raced to build the backbone of the internet. So the equipment makers, Lucent, Nortel, Cisco, lent their own customers the money to buy their own equipment. Billions of it. Some carriers went further and sold each other network capacity, booking the swaps as revenue, the same cash washing back and forth to make demand look enormous. Congress later hauled some of them in to explain it. It looked like a boom. It worked beautifully, right up until the real demand never showed up. The loans went bad. The fiber sat dark in the ground for years. Companies collapsed. Now tell me if this sounds familiar. Today, Nvidia invests billions of dollars into OpenAI. OpenAI turns around and commits hundreds of billions to cloud providers like Oracle. And those providers spend that money buying Nvidia's chips, the same dollars circling a small ring of companies, making everyone's revenue look spectacular. By 2026, analysts have counted more than $800 billion tangled up in these circular deals. And the engine at the center of it? OpenAI has committed to spending something like $1.4 trillion over the next several years, while, by some estimates, losing around $14 billion in 2026 alone. Sit with that. Trillions in promises, billions in losses. A lot of it powered by the same money going round and round the same circle. Now, to be fair, the optimists have a case. They argue the demand for AI is real this time, that actual businesses are paying real money, and that this is nothing like the empty websites of 2000. They might be right. But that is exactly what the believers said in 1999 and in 2007 too. Because here's what's constant: overvaluation, concentration, circular money, 3 warning lights. They lit up in 2000. They lit up in 2008. And in 2026, all 3 are glowing at the same time, brighter than they ever have. Which brings us all the way back to the man from the very beginning. Warren Buffett, the most patient investor alive. At the height of the market frenzy of the late 1960s, he shut his partnership down and handed the money back, and was proven right when it all unraveled. In 1999, they laughed at him again, called him a dinosaur who just didn't understand the new economy. 2 years later, the people laughing lost fortunes, and Buffett walked through the wreckage untouched. So look at what he is doing right now, not saying, doing. Between 2022 and 2024, his company sold roughly $173 billion of stock. By early 2026, its cash pile had swelled to a record $397 billion, the single largest hoard of cash any company has ever held in American history. More than the cash of Apple, Amazon, Google, and Microsoft combined. He hasn't gone on television to scream crash. He doesn't need to. The cash is the warning. When the greatest buyer of businesses who ever lived stops buying and instead piles up a mountain of cash taller than anything in corporate history, he is telling you, in the only language that cannot lie, that he cannot find a single thing worth the price. And here's the detail that turns this from a story into a countdown. There's a rhythm in land and property that has repeated for roughly 200 years, about every 18 years, a peak and then a fall. The economist who tracks it called the 1990 downturn years early, and famously called the 2008 crash back in the 1990s. Both times, almost to the year. So do the simple arithmetic with me. 2008 plus 18. His forecast for the next great peak and the drop that follows it lands on a single year, 2026. And he warns it could be worse than 2008. And this is no longer just theory on a chart. In June of 2026, stock markets across Asia had to slam on the brakes and halt trading twice in 1 week. Samsung and SK Hynix fell 12% in a single morning. Oracle just had its worst week since the dot-com crash, and the world's central banks issued a rare, blunt warning. If the AI bubble bursts, it could set off the next global crash. So, did you notice? That's the secret hiding inside 2008. They were never two separate accidents. They were the same machine, running the same play, twice. Prices stretched to the top. The whole market balanced on a handful of names, fake demand circling in a loop, and the smartest money in the room quietly slipping toward the exit while the crowd cheered louder and louder. The only thing that ever changes is the story printed on the poster. The machine underneath is always the same. Now, am I telling you to sell everything and bury gold coins in your backyard? No. Nobody can call the exact day, not even Buffett. He just makes very sure he's holding the umbrella before the first drop lands. History doesn't repeat itself, but it rhymes. And right now, it is rhyming a little too cleanly for a guy who wears a skull to work. If this changed the way you see the market, even a little, do me one favor and hit that subscribe button, because on Strategy State, we spot the pattern before it's on the evening news, not after. I'm Sargon. Keep your eyes on the exits, and I'll see you at the next one.